While most people are arguing over short-term price action, some of the biggest macro, regulatory, and institutional signals we've seen in months are quietly aligning at the same time. Consumer sentiment just collapsed to historic lows. ETF inflows are exploding toward record territory. Ethereum sentiment has flipped deeply bearish again. The SEC just approved options trading tied to the Nasdaq Bitcoin Index, and major institutions are now forecasting trillions of dollars in tokenized assets moving on-chain within just a few years. Nothing in this video is financial advice. This is for education and entertainment only. Always do your own research before investing in crypto or digital assets. Welcome back to Ledger Pulse, the channel where we break down the biggest developments shaping digital assets, tokenization, institutional finance, and the future of blockchain infrastructure. If you've been watching the market closely, you already know something much bigger is happening beneath the surface. Because while retail focuses on short-term volatility, institutions continue building tokenized systems, digital settlement infrastructure, ETF exposure, stablecoin rails, and blockchain-based financial networks at a pace we've never seen before. And today's episode might be one of the clearest examples of that shift yet. So let's get into it. One of the biggest macro stories this week came from consumer sentiment data. According to reports, U.S. consumer sentiment has now fallen to its lowest level on record in data stretching back to 1952, even lower than levels seen during portions of the 1980s inflation era. At the same time, inflation expectations reportedly climbed again, with consumers expecting prices to continue rising over the next 12 months. That creates a very strange environment for markets, because on one hand, people are financially stressed, confidence is weakening, and economic uncertainty remains elevated. But on the other hand, capital continues pouring aggressively into financial markets, and historically, periods of uncertainty often push investors toward alternative assets, inflation hedges, and asymmetric opportunities. That's part of why crypto keeps re-entering the conversation during unstable macro cycles. Now here's where things become really interesting. The Kobisi letter reported that US ETF inflows are running at record levels. According to the data, hundreds of billions have already flowed into ETFs this year. Inflows are significantly ahead of previous years, and current pacing could push the total inflows past the $1 trillion mark surprisingly quickly. That is enormous institutional capital movement. And this matters because ETF infrastructure has completely changed how traditional investors access markets. Capital that once avoided crypto entirely can now gain exposure through regulated financial products. And every cycle, the market structure keeps becoming more institutionalized. Less retail-driven, more infrastructure-driven. That's a major shift from the earlier crypto cycles many people are used to. Sentiment highlighted another fascinating development this week. Ethereum sentiment has reportedly flipped heavily bearish across social media and retail discussion. And historically, extreme bearish sentiment often appears near important turning points. We've seen this pattern before. Retail enthusiasm disappears, narratives turn negative, confidence collapses, and then markets eventually reverse when positioning becomes too one-sided. One post even pointed out that many people once believed Ethereum at under $100 was a scam during the previous cycle. Now, some of those same participants are bearish again, after massive long-term growth already occurred. That doesn't guarantee Ethereum moves higher immediately, but it does highlight how emotional market psychology can become during volatile periods, because sentiment often swings far more aggressively than fundamentals. Another major talking point surfaced during a CNBC discussion around productivity growth and structural economic shifts, with Kevin Warsh, the new Fed chair. The conversation centered around the possibility that the economy may be entering a new technological phase while many policymakers are still using outdated frameworks. And honestly, that discussion applies perfectly to digital assets too, because blockchain, tokenization, AI, and automated settlement systems are all part of a much broader technological transition. Markets may not be moving toward a simple crypto replace banks future. Instead, we may be moving toward hybrid financial systems, where traditional finance, digital assets, AI infrastructure, and tokenized settlement layers all merge together. That's increasingly where the market appears to be heading. One of the biggest long-term predictions came from Standard Chartered. According to forecasts discussed this week, trillions of dollars in tokenized assets could move on-chain by the end of the decade. And importantly, those estimates are not just focused on crypto-native assets. They include stablecoins, RWAs, tokenized securities, and broader digital financial infrastructure. This is why tokenization keeps becoming one of the most important narratives in the entire industry. Because if even a fraction of traditional finance eventually moves onto blockchain rails, the infrastructure demand becomes enormous, and suddenly networks capable of compliance, settlement, interoperability, liquidity, and scalability become extremely valuable. That's exactly why the XRP ledger, Ethereum, and other infrastructure-focused networks continue attracting institutional attention. Another development that flew under the radar involved Project 11 partnering with Ripple to explore post-quantum security on the XRP ledger. Now, this may sound highly technical, but it's actually a very important topic for long-term blockchain infrastructure, because quantum computing could eventually create security risks for existing cryptographic systems. And if institutions plan to settle massive amounts of value on blockchain networks in the future, security becomes everything. The fact that projects are already auditing validators, custody systems, and wallet infrastructure for future quantum resilience shows how seriously long-term infrastructure planning is being taken. Again, this is not meme coin behavior. This is infrastructure preparation. We also saw another important regulatory milestone this week. The SEC approved options trading tied to the Nasdaq Bitcoin Index. That matters because derivatives markets are one of the biggest drivers of institutional participation. As markets mature, institutions want hedging tools, options exposure, structured products, and advanced liquidity mechanisms. That's how traditional finance operates. And crypto increasingly appears to be integrating directly into that system rather than replacing it entirely. At the same time, discussions around the Clarity Act and broader crypto legislation continue progressing through Washington. There are still delays, still disagreements, still political friction. But compared to previous years, the tone has changed dramatically. The conversation is no longer, should crypto exist? Now it's, how do we regulate it? How do we integrate it? That's a huge difference. So when you combine all these developments together, you really start seeing a much larger transition forming. Consumer confidence collapsing, massive ETF inflows, institutional derivatives expansion, tokenization forecasts reaching into the trillions, regulatory frameworks evolving, quantum security preparation, and blockchain infrastructure continuing to mature quietly in the background. This no longer feels like the early speculative phase of crypto. It increasingly feels like the financial system itself is slowly digitizing, and the market may still be underestimating how large that transition could become over the next decade. Because eventually, the biggest winners may not be the loudest projects on social media, but the networks institutions quietly build around while everyone else is distracted by short-term volatility. So while headlines focus on daily price swings, the real story may be happening underneath the surface. The infrastructure is evolving, the regulations are evolving, institutional participation is evolving, and tokenization continues moving closer to reality. The next phase of this market may look very different from the last one. If you enjoyed this breakdown, drop a like, subscribe, and let me know in the comments. Do you think the market is underestimating the long-term impact of tokenization and institutional adoption? Or are expectations already getting ahead of reality?